Welcome to the deep dive. You're here because you want to understand your financial landscape without drowning in a sea of jargon.
Right, or feeling totally overwhelmed by information overload.
Exactly. You want the critical insights, the aha moments, and you want them delivered straight, respecting your time.
Which is what we are all about.
So today we are looking at something that feels almost ancient, but it's actually incredibly relevant to modern portfolio theory.
Yeah, it really is.
We're talking about adding physical gold to a retirement strategy. Specifically, we are parsing the mechanics of gold IRAs.
It's a fascinating space,
Let's,
honestly.
let's unpack this.
hmm
If you were exploring how to diversify a retirement portfolio with precious metals, you immediately hit a wall of structural complexity.
Oh yeah, massive wall.
Right. So our mission today is to demystify the critical functional differences between a gold IRA company and a gold IRA custodian.
Which sounds like a minor detail.
It sounds like purely administrative paperwork.
Exactly. But looking at the research, conflating the two is, well, it's the easiest way to just fly blind into a major financial decision.
So to map this out, we are relying on some incredibly robust source material today.
We really are. We're drawing directly from the comprehensive market research published by the Gold IRA Company's Bulletin, specifically the analysis authored by Doug Young.
And Doug is not just some guy writing blog posts, right?
Not at all. I mean, we don't need to spend 10 minutes reading his entire resume, but it is definitely worth noting that he brings over 20 years of financial market experience to the table.
20 years is a lot of market cycles.
Yeah, and he spent the last 15 years specializing exclusively in gold IRAs. Plus, he was a financial director for 16 years at World Freight Services Ltd.,
Wow, okay. So he understands both the finance side and the heavy logistics side.
which is crucial for physical gold. And since 2011, he has systematically evaluated over 80 different gold IRA companies. He has done all the heavy lifting so we can get straight to the actual insights.
I really appreciate having a researcher who has systematically pulled apart the operations of 80 different firms. It gives us a completely objective baseline, which is kind of rare in this space.
It is very rare.
So let's jump right into the cast of characters you're going to meet when you initiate this process. The source material uses this brilliant framework that makes the whole architecture instantly clear.
The Trek analogy, right?
Yeah, the trek analogy. Setting up a gold IRA is framed like setting out on a trek in completely unfamiliar, high-stakes terrain. In the world of precious metals retirement accounts, the Gold IRA company is your expert guide.
You guide through the wilderness.
Exactly.
Mhm.
Their specific role is front-end logistics. They educate you on the landscape, outline the benefits, the risks, and they help you select the right gold products for your specific allocation.
Because you can't just buy any random gold bar.
Right, which we'll get to later. But basically, because you're shifting into a self-directed IRA for these physical assets, the paperwork is incredibly dense. The company handles that initial administrative burden and coordinates the actual logistics of buying the gold. They map the route and walk alongside you.
Right. And if the company is your guide, then the Gold IRA custodian is the guardian. Specifically, they are the guardian of the vault.
Guardian of the Vault, I like that.
It's accurate. Once your guide facilitates the acquisition of the precious metals, those assets need a highly secure, compliant destination. The custodian is the entity legally responsible for the physical safekeeping of those assets.
And this isn't just a suggestion, right?
No, not at all. If we connect this to the bigger picture, this separation of powers isn't just a matter of convenience or adding an extra layer of consumer security. It is a strict legal reality dictated by the IRS.
Meaning you can't just keep the gold yourself.
The IRS absolutely forbids any investor from managing their own gold IRA. You cannot take physical delivery of the gold and just keep it in a floor safe in your basement.
Even if it's a really good safe.
Doesn't matter how secure you think your home is. You must use a qualified, institutional custodian. Their duties are incredibly rigorous to prevent any self-dealing or market manipulation.
What do those duties actually look like day to day?
Well, they place the physical gold in a secure, IRS-approved depository. They ensure the asset is fully insured against any loss or damage while it's vaulted. And from a regulatory standpoint, they act as the ultimate record keepers.
So they are doing the IRS paperwork.
Exactly. They track the purchase receipts, maintain the storage manifests, and handle all the necessary tax reporting to both you and the government. They basically maintain the entire chain of custody.
Looking at how these two entities interact, it seems like setting this up could be a complete logistical nightmare if you had to source them separately. Like finding a guide and then totally independently finding a guardian.
It could be, yeah. But the research indicates it's usually a dynamic duo situation. A reputable Gold IRA company already brings established working relationships with recommended custodians to the table.
Oh, so they introduce you to a custodian they already trust.
Yes, they already know which depositories have the best security infrastructure and which custodians handle the IRS reporting most efficiently. They will actively facilitate that relationship for you.
But wait, does that mean you are forced to use their specific custodian?
That is a great question, and the answer is no. The crucial takeaway for you as the investor is that the final choice of custodian always remains yours.
Okay, that's good to know.
The company acts as the guide and makes a strong recommendation for their preferred vault partner, but you hold the ultimate veto power. You are never locked into a prepackaged deal if your own due diligence points you toward a different depository.
That structural separation is actually a great protection mechanism for the investor.
It keeps everyone honest.
Yeah. Now let's get into the actual mechanics of the transition. Let's follow the money.
The most important part.
The setup involves a clear three-step sequence. First, you submit the application for a self-directed IRA. Second, you lock in your choice of custodian. And third, you execute the rollover of funds from your existing retirement vehicles into this new Gold IRA.
Right, but that third step, the rollover, that is where investors face the biggest behavioral and financial trap.
The direct versus indirect rollover.
Exactly. Moving funds from a traditional 401k or IRA into a Gold IRA needs to be executed as a direct rollover to avoid massive friction. The direct rollover is essential.
Define direct rollover for us.
That means the capital moves institution to institution. The funds go directly from your old account provider to your new custodian. The money literally never touches your personal checking account.
And the alternative is what? An indirect rollover?
Yes, and that is basically walking a tightrope without a net. In an indirect rollover, your current provider liquidates the funds and cuts a physical check directly to you.
And then you have to move the money yourself.
You are then solely responsible for depositing that exact amount into the new Gold IRA. And the IRS gives you a strict 60-day window to complete this maneuver.
60 days sounds like a lot of time, but things happen.
Things absolutely happen. And if you miss that deadline by even a single day, the IRS immediately classifies the entire amount as an early withdrawal.
Ouch.
Yeah, ouch is right. You trigger the full tax burden on the balance, plus potentially massive early withdrawal penalties. A direct rollover bypasses that 60-day window entirely, completely removing the psychological stress and the tax risk.
Because nobody wants to accidentally forfeit 20% or more of their retirement capital to the IRS just because a check got delayed in the mail or they miscounted the days on a calendar.
Exactly.
Here's where it gets really interesting. Let's pivot to the ongoing mechanics of keeping this account open, specifically the fees. Because unlike paper assets, where you might just see a tiny expense ratio skimmed off the top, physical gold has tangible carrying costs.
Oh man, the carrying costs. This is exactly why it pays to be incredibly detail-oriented here. The taxonomy of these fees is very specific. And I admit, I get a little too excited about this part, but it is so important.
Get excited. We need to know this stuff.
Doug Young's research categorizes 5 distinct types of fees you have to account for. If you don't understand these 5 buckets, you cannot accurately compare one Gold IRA provider against another.
Right. Let's break down that taxonomy. What's bucket number 1?
The first is the setup fee. This is a one-time administrative charge for opening the self-directed IRA and handling the initial transfer logistics.
And how much is that usually?
Depending on the company, this can range from a nominal token amount to several $100s.
Okay, bucket 2.
Right behind that is the annual maintenance fee. The data shows this typically runs between $100 to $300 a year. This goes to the custodian for servicing the account and executing that mandatory IRS compliance reporting we talked about earlier.
Makes sense. And the third bucket?
Then you hit the third category, which is the storage fee. And this is where the math really matters over a long timeline. This money doesn't go to the Gold IRA company. It goes directly to the physical depository where your bullion is sitting.
And how do they calculate that?
That's the critical detail. Some depositories charge a flat annual rate, while others charge a scaled percentage based on the total value or total weight of the gold you hold. It covers the climate control, the armed guards, and the high-tech vault infrastructure.
And the distinction between a flat rate and a scaled percentage is massive when you think about compounding over a 15 or 20-year retirement horizon.
It really is.
Like, a flat $150 storage fee is predictable. But if you pay a percentage and the price of gold doubles over a decade, your storage fees double right along with it, eating into your net returns.
Exactly. You have to forecast those costs. You can't just look at year one.
What's the fourth fee?
The fourth category is the insurance fee. The IRS requires the gold to be fully insured against loss or damage while it sits in that vault.
Is that usually separate?
Often, this cost is bundled directly into the storage fee. But you cannot just assume that. You have to explicitly verify that insurance is included in the quoted storage price so you aren't hit with a secondary bill or worse, left holding an uninsured asset.
Which brings us to the fifth category, transaction fees.
Yes.
These are the markups or costs associated with the actual buying and selling of the physical metal within the IRA. The transparency of this fifth fee is usually where investors get blindsided if they aren't paying close attention to the spread the company is charging.
Knowing this exact five-part menu setup, maintenance, storage, insurance, and transactions, is how you outmaneuver the traps. Because while these categories are standard across the industry, the way they're disclosed is not.
So they might hide things in the fine print.
Oh, absolutely.
Yeah.
You have to be hyper-vigilant about hidden charges. Some companies might bury arbitrary fees for transferring funds into the fine print. Or, if you ever need to liquidate your gold early or sell it back to them, there might be hefty undisclosed penalties.
So what's the best defense mechanism?
It's simple. Before you sign anything, demand a complete, written, itemized breakdown of every possible fee and penalty. If the representative hesitates or the documentation requires a law degree to parse, you walk away.
You want a guide who is brutally honest about the cost of the expedition up front.
Perfectly said.
Speaking of what you are actually paying to store and insure in those vaults, let's look at the asset itself. Because the IRS demands a highly specific level of purity for these accounts. You can't just drop a vintage gold watch or inherited jewelry into a self-directed IRA.
Not even close. The IRS purity standards for investment-grade assets in a gold IRA are uncompromising.
How pure does it have to be?
The physical gold must be exactly 99.5% pure, and it's not just the chemical purity, it's the physical form. The gold must take the shape of highly specific IRS-approved coins or bars.
What kind of products actually qualify then?
The research highlights exactly what qualifies. You are looking at products like American Gold Eagle coins, Canadian Gold Maple Leaf coins, and certain accredited gold bullion bars. These are standardized products minted by sovereign nations or heavily accredited manufacturers.
And that standardization isn't just bureaucratic red tape, it's the engine of liquidity.
Yes, exactly.
When a coin is precisely 99.5% pure and globally recognized, the custodian doesn't have to assay or test the metal when it comes time to sell it. The market instantly knows its exact weight and value.
It makes selling it later so much easier.
But accessing these highly pure standardized assets requires a bit more capital than opening a standard index fund. The research notes distinct barriers to entry.
Minimum investment requirements are standard operating procedure in this industry.
Right. While the exact floor varies by company, the data shows it is incredibly common to see minimums sitting between $5,000 and $10,000 just to initiate the account and execute the first purchase.
Some firms cater to high net worth individuals and set that bar substantially higher, maybe $50,000. But that $5,000 to $10,000 range is the typical starting line. What's fascinating here is how those financial thresholds attract bad actors.
Oh, because there's a lot of money moving around.
Exactly. When you have an industry built around moving thousands or tens of thousands of dollars of retirement capital, often driven by an investor's anxiety about the broader economy, predatory behavior naturally follows. You have to know how to outsmart them.
What are the red flags we should be looking out for?
Doug Young's research outlines several glaring red flags. The most obvious is aggressive sales tactics. If a representative is applying high-pressure closing techniques, creating a false sense of urgency, or trying to use fear-mongering about the stock market to get you to buy immediately, that is a massive warning sign.
They shouldn't be rushing your retirement decisions.
Never. A legitimate Gold IRA company operates as an educator, not a boiler room closer.
The second major red flag highlighted in the source is the promise of unrealistic returns. Gold is historically a stabilizing asset. It functions as a store of value and a hedge against inflation.
It's not a get-rich-quick scheme.
Right. If a sales rep is promising you that your physical gold allocation is going to generate massive exponential growth or double in value in a year, they are simply detached from historical reality.
Run the other way.
And the third red flag ties directly back to our fee taxonomy: opacity. If they cannot give you a straight, binding answer on what your total carrying costs will be over the next decade, do not hand them your capital.
So how do you practically vet these companies before you commit? The methodology and the research provides a great stress test.
What's step one of the stress test?
First, you bypass the glowing testimonials on their own website and aggressively check independent third-party reviews. Second, you audit their record with the Better Business Bureau. And you aren't just looking for an A-plus rating, you're looking at how they actually resolve consumer complaints when logistics go wrong.
Because things will eventually go wrong in any logistical business. It's about the resolution.
Precisely.
The third vetting technique is testing their customer service responsiveness directly before you ever hand over a dollar. Call the company and intentionally ask difficult, granular questions about their storage fee structures and their custodian partnerships.
See how they react.
Do they take the time to transparently break down the math, or do they try to pivot you back to a sales pitch?
That pivot tells you everything you need to know.
And to give this some concrete context, the Bulletin's research specifically cites Augusta Precious Metals as a benchmark for this kind of operational transparency. They are noted in the data for making compliance a core part of their business model.
Having a factual benchmark like that is incredibly useful when you are running your own evaluations on other firms. You measure them against the standard.
Absolutely. Comparing any potential guide against a verified benchmark is how you spot the outliers immediately.
Okay, so we have mapped out the front end.
Yes, setting the account up, navigating the rollover traps, analyzing the fees, and buying IRS-compliant gold. Let's shift our timeline and look down the road. Let's talk about the endgame.
The ultimate question.
You spend decades allocating capital to this self-directed IRA, the custodian guards the gold in a vault, and then retirement actually arrives. It's time to take distributions. The physical gold doesn't just automatically evaporate into cash in your bank account. What are the actual logistics of accessing that wealth?
You have two very distinct logistical choices when it comes to distributions, and each triggers a different tax reality.
What's the first option?
Your first option is taking physical possession of the asset. The custodian literally ships the physical 99.5% pure coins or bars directly from the depository to your home.
So a truck just shows up with your gold?
Basically, yes. But if you choose physical delivery, you pay taxes based on the fair market value of the gold at the exact time it is distributed to you. It is treated as ordinary income by the IRS.
And then you have to deal with the gold itself.
Right. The logistical burden also shifts entirely to you. You now have to figure out how to safely store it, whether that means installing a high-end safe or securing a private safety deposit box, and you have to purchase independent insurance writers to protect it.
Which sounds like a lot of work. So the flip side of taking physical delivery is the second choice, selling the gold and taking a cash distribution.
Yes, the much simpler route for most people.
In this scenario, you instruct the custodian to liquidate the precious metals on the open market on your behalf. They execute the sale, and you receive a standard cash deposit into your account. The cash itself is taxed as a distribution, functioning exactly like a normal withdrawal from a traditional IRA.
The choice really comes down to utility. Do you need the liquid cash flow to cover daily living expenses in retirement? Or do you want to hold on to the physical metal as a continuing generational store of wealth?
And this decision forces a broader conversation about your overall portfolio strategy.
Definitely. Physical gold is a powerful, historically proven tool, but it is just one piece of a much larger macroeconomic puzzle. It's primarily a mechanism for diversification. It provides a hedge against inflation and systemic economic uncertainty.
But it shouldn't be everything.
No, it should not be the entirety of your retirement strategy. It needs to sit in balance alongside traditional yield-generating assets like equities, mutual funds, and bonds. You don't want all your capital locked in one asset class, even if that asset class is immune to corporate bankruptcies.
Balance is the key. And the research points out that balance is not a set-it-and-forget-it state. It requires active, ongoing recalibration.
You have to pay attention.
You need to reevaluate your Gold IRA allocation if your personal retirement timeline shifts unexpectedly. You need to look at it during periods of major sustained market volatility. Or you might need to rebalance if the spot price of gold hits distinct historic highs or lows.
It demands active participation, requiring you to work continuously with your guide and your guardian to ensure the portfolio still serves its primary function.
So what does this all mean? We have navigated a massive amount of structural information today.
We really covered a lot of ground.
The core takeaway is this. The infrastructure of precious metals investing does not have to be an intimidating black box. By clearly understanding the strict, legally mandated division of labor, your Gold IRA companies functioning as your logistics guides, and your Gold IRA custodians operating as your unyielding vault guardians, you completely demystify the
It
process.
becomes manageable.
Exactly. Armed with an understanding of how to audit the five-part fee structure, execute a seamless direct rollover, and spot the behavioral red flags of predatory firms, you can approach this market with clinical confidence and take proactive control of your financial future.
Knowledge is defense.
If you want to dive deeper into the exact methodology we discussed today, and I highly recommend reviewing the raw data before you initiate any type of IRA rollover, you can access Doug Young's complete comparative market analysis of the top performing companies at the Gold IRA Companies Bulletin.
It's a great resource.
That specific research is located at goldiracompaniescompared.com. Again, the factual source material is at goldiracompaniescompared.com.
As we wrap up this analysis, I want to leave you with a final provocative thought to mull over. We have spent this entire time dissecting strict financial mechanics, IRS tax codes, and fee structures. But step back and think about the nature of money today.
Okay, I'm listening.
You spend your whole life building a retirement nest egg as numbers on a digital screen. You log into an app, you see a balance, and that abstract number represents your life's work and your future security. But when you translate a portion of that wealth into a physical, heavy block of gold sitting securely in a vault, well, it profoundly changes your psychological relationship to your own money.
It makes it real.
It does. It begs the question, in a fully digital, increasingly abstract world, how much of your security do you actually want to be able to hold in your hands?
That is a fascinating question to chew on as you audit your own financial landscape. Thank you so much for joining us on this deep dive. We appreciate your curiosity, your time, and your drive to build a more resilient portfolio. Until next time, keep exploring.